Welcome to the introduction to microeconomics. So we're going to look at the definition of economics and define the basics of economics, which stream from scarcity, choice, rationality, opportunity cost, and the marginal concepts. And so we will begin by understanding the world of economics, which comprises of both micro and macroeconomics. We're also going to look at the positive and the normative theories and explain why and how to study economics. Later, we'll also break down the methods of economics. So to start with, as we explained in the previous class, that economics thrives on scarcity. And because resources are scarce, there must be good decision-making that has to be made on the limited resources. Hence, we need to make choices that are optimal. So in an economy or a society made of different households with different needs, households needs to make decisions based on the scarce resources. So society must therefore decide what must be divided or must be done and for whom and where. So there are three basic questions that must be answered in economics, and we'll break them down. So it is therefore a need that people need to grow food, people need to make clothing, and also design different kinds of products and services because of scarcity. And once an economy, a society has allocated these resources to the people, various allocations of jobs to the various needs, we must therefore decide what type of food, what type of goods, and what type of transport, and what type of services must be offered to whom. So we're going to look at the principle of scarcity and how scarcity can be illustrated using the PPF or PPC. And also we need to decide the definition of economics based on our understanding. So economics has been defined by different scholars as how society manages scarce resources. Others call it a study of choice under scarce conditions. So in most instances, when we're dealing with economics, we're actually dealing with our abilities to make decisions and choices under very tough conditions. So economics, you cannot do away with scarcity and you cannot do away with choices. And so we're going to look at firstly the concept of scarcity. What is scarcity? Scarcity is simply a situation in which something is not readily available. Something is insufficient to satisfy the desire at hand. So when we're dealing with scarcity, in nature, we're dealing with limited resources. And so scarcity and individual choices must therefore marry. Where there are unlimited resources, there's no need for us to study economics. And as such, I'll confidently say economics will not be relevant in heaven because everything will be available. Nonetheless, prudent choices must be made. We must be trained now whilst on earth because we have limited time, we have limited resources, we have limited spending time. So scarcity spreads along these two basic limitations: scarcity in time, scarcity in money. So being limited with hours in a day to satisfy our desires, we need to divide our time optimally. Being limited with finances, we cannot afford anything and everything. Hence, we need to make decisions using our budgets. So we're going to look at how to break down the budget lines between two available options or choices. So please, as I'm breaking this down slowly, I need you to understand how questions will come. So scarcity, we have broken down a synonym of scarcity to a limitation. So The limitations force us to make tough decisions as economists. These tough decisions bring about choices, and consequences therefore come due to the choices we're going to make. So effects that will come from these individual choices will either be direct or indirect. And so society should face different kinds of choices amidst the 4 kinds of resources that are available. Number 1, choices over the resource of labor. Labor, we're talking about human capital. Labor, we're talking about human capital, basically. And we have capital, which comes in terms of machinery and human capital itself. We have land or natural resources. And the other category of a resource that we must look at is entrepreneurship. So these are the key resources we must make decisions over. Now, the problem of scarcity can be addressed if choices are made by 3 key entities: the households, the firms, and government agencies. So households have limited income that they need to allocate amongst the goods and services that they wish to consume. Firms also will need to make decisions on the cost of production. So they need to make decisions in how they will split the cost to produce the targeted or intended produce. And government agencies too have limited choices over how to satisfy the goals of the citizens. So government, through their government spending, must make optimal decisions to ensure that its citizens are optimally satisfied. So as economists, it is important that decisions that are made by firms, households, and governments are made to explain the how the economic system works. Decisions must also be made to focus for the future economy, how much must be produced to meet the demand in the nearby future. Also, must suggest ways in which the government will make the future better. So all these decisions that are being made, especially now that we have an economist who's the president, these decisions have to be made in tandem with the goals of the nation, the needs of the nation. So we're going to break down our study in economics on 3 basic concepts. So we're going to look at the concept of opportunity cost, the concept of rationality, also the concept of marginal concept, the marginal concept. So what do we mean when we're dealing with opportunity cost? Opportunity cost is a fundamental concept in economics, which refers to the value of the next best alternative forgone when making a decision. So when we're dealing with opportunity cost, in other words, it simply represents the cost of choosing one option over the other. You want to make a decision as a nation, and there are 2 available options. If you give up a potential benefit or a gain in place of the other, that benefit that you've forgone is what we call opportunity cost. For instance, right now, you have given up your pleasure to either go and watch soccer at the expense of your exams. So you're in class, that's the opportunity cost, the enjoyment you're supposed to have. So it is very important to note that opportunity cost is a concept that all economists must understand. For instance, let's say you have a 10 kwacha and you want to spend it on a movie ticket at Stakenico or to buy a book. So if you choose to go and watch a movie, the opportunity cost in this case is simply the value of the book that you have forgone instead. Alternatively, if you decide to buy the book, what is the opportunity cost in that concept? The opportunity cost is the enjoyment of the experience you could have had watching the movie at Stakenico. So you need to understand the concept of opportunity cost, because this is a concept that will help you individuals and will also help businessmen to make informed decisions by considering what we call the trade-offs. There's also a concept of rationality, which assumes that individuals, whenever they're making decisions, will usually act in their own best interest. So we understand that individuals are rational beings, always wanting more to themselves than for others. So it is a fundamental principle in economics, therefore, when you're making decisions. According to this, there's what we call the rational choice theory, which assumes that individuals will always make choices that will maximize their personal utility or satisfaction. That is what the theory says. So it is, however, very important to note that rationality doesn't imply that people always make optimal or the best or the perfect decisions. No. This theory simply assumes that individuals have limited information. They have cognitive constraints. They also have subjective values. So this therefore means that it will lead to them deviating from strict rationality. So in economics, more specifically, there's what we call behavioral economics. We are told that people, their decisions are usually influenced by their psychological biases. And so therefore, we usually deviate from the standard assumptions of rationality. So this is the concept of rationality that you need to understand, which simply assumes that individuals, they usually act in their best interests based on on the consistent preferences. Then finally, we have what we call the marginal concept. This is a concept which in economics assumes an incremental or additional change resulting from a decision or an action. So this usually focuses on the effect of small incremental adjustments rather than the overall changes. The term marginal simply means what? Additional. So if we have marginal cost, marginal revenues, just additional. So this concept in economics simply assumes or examines the incremental changes that result in the decisions we make. Any change should have a marginal effect on our life. For instance, if we're going to consider the concept of marginal utility, it simply suggests that satisfaction is usually derived from consuming an additional unit. So if you're very hungry and you're eating a mango, every additional mango you eat adds to your satisfaction. The first slice of pizza you eat may bring significant enjoyment, but as you consume more slices, you discover that you get to loathe the pizza that you're eating. So you start increasing at a decreasing rate. So that is what we call the marginal concept. So these are the three basic concepts that will give a fundamental understanding in economics. I'm an economist by profession, so I try to bring these to their simplest possible manner. All right. So how do people therefore make decisions? So we need to understand that there's no mystery to what an economy is. So an economy is just a group of people who interact with one another as they go about in their lives. So because this behavior of an economy reflects the behavior of individuals who make up the economy, so we're going to consider 4 principles of individual decision-making. So number 1, there are 4 key principles. The first one is the principle that people face trade-off. Okay, so based on the age, there is no such a thing as free lunch. So an individual, to get one thing he likes, he usually has to give up another. Thus, this decision requires a trade-off. So what is a trade-off? From what I've just defined, what is a trade-off? A trade-off simply means choosing one option at the same time sacrificing the other. So trade-offs usually arise in the fact that resources are scarce. By choosing one activity over the other, it does not mean we want to sacrifice the other. It's just because we understand that there is limited available resource. If we were given a chance, we would want to get both free lunch, free ice cream. But the decisions we make are solely based on the fact that we cannot have it both ways. So the other decisions that we make, so I've explained on trade-off. So trade-off examples could be having a clean environment versus a high-level income, efficiency versus equity. So these ones sometimes may not go together because you have to sacrifice one for the other. All right. So the other decision will be recognizing that people face trade-offs does not itself inform us that decisions will and should make. Okay, this one is still under the same decision. The second is about the cost of something. We're taught that the cost of something is what you give up to get it. So trade-offs usually require that people compare the costs and the benefits of the alternative courses of action before making a decision. So we must note that the cost of something or some action is not obviously as it might at first appear. For instance, the decision of whether to go to university or not, the benefit of the intellectual enrichment and the life of a proper job. So all this hinges around a number of factors. Number one, the cost of going to get that particular university degree. And also the other is on the benefit that is perceived after I get that degree. So the decision that we make mainly for, number one, people face trade-offs. Secondly, the cost of something is what you give up to get it. And thirdly, the rational people think at the margin. So here, the term marginal changes, like I said, is incremental adjustment to life. So in many situations, people will make the best decision by thinking of what it will add to their lives. For instance, the time for exams, the decision of either blowing off the 24 hours in a day by watching TV, going to watch your maps, or spending time having to do what? To cram these theories of dead men. The fourth and last is how people respond to the incentives. So people's behavior will change when the costs or benefits change, since decisions are based on these factors. So policymakers should always consider the incentives because many policies change the cost and benefits faced by people. So basically, this is on the choices that we make. Now, I want us to now go on the concept of microeconomics. Microeconomics emanates from the Greek term micros, which means small. So microeconomics, therefore, is the study of individual behavior of firms, households, and governments on the choices they make and the interactions in a specific market. So microeconomics is simply a branch of economics which examines the behavior of individual decision-making. That is, on the perspective of the firm, the business, or the households. So we have two key, there's micro and macro. Macro also comes from a Greek term which means macros, meaning large. So when you're dealing with macroeconomics, we're basically looking at the overall economy as a whole, the bigger picture. It ignores the small, fine details. So the branch of economics that examines the behavior of the aggregate economy, the income, the employment, the national scale, that is what we call macroeconomics. So we can therefore distinguish the two as follows. When we're dealing with microeconomics, we're basically looking at production in the individual firms, businesses, and industry, whereas the macro looks at the national production. When we're dealing with the prices, we look at individual goods and services, where macro looks at the aggregate level of pricing. Income, we're looking at the distribution of wealth for individuals, whereas this one looks at the national income, the wages, the salaries. Employment, we're looking at the individual levels of employment, whereas macro looks at the aggregate employment level in the economy as a whole. So these are the differences that we could look at. So when we're dealing with positive in normative economics, what are we looking at? So when you're looking at this, are you still able to see my screen? Are we following? Are you able to see my screen?
Yes.
Are there any questions?
Yes, we are.
Are we following? So what we have so far is a theoretical part of economics that I cannot do anything about, you just need to understand. So when you're looking at the positive economics and normative economics, when you're dealing with positive economics, simply an approach that focuses on the objective analysis and description of an economic phenomenon without incorporating personal opinions, the values, or ethical considerations. So when you're dealing with positive economics, we're simply explaining how the economy works and predict how it will behave based on the observable facts. For instance, a positive economic statement would be an increase in the minimum wage will therefore decrease employment among low-skilled workers, because if you're increasing minimum wage for maids, will not afford them. So meaning we'll rather employ our relatives or work for ourselves. So this statement can be tested, can be verified using statistical data. Normative economics, on the other hand, deals with subjective statements. These should give us a picture of how the economy should be and what actions or policies are desirable. So it requires us coming up with recommendations or prescriptions of how certain decisions based on personal beliefs and ideologies will affect the economy as a whole. So in normative economics, for instance, a statement that government should increase taxes on the wealthy to reduce income inequality, this statement reflects a subjective opinion about what should be done based on the belief of reducing inequality. So therefore, when you're dealing with normative economics, we basically making statements that cannot be proven or disproven, since they're only based on individual opinions. So normative, in short, positive economics basically is descriptive, whereas normative is prescriptive. So normative economics basically looks at what should be, whereas positive economics looks at how the economy works. It gives a perspective of, can it be true or false? Can it be tested by looking at the facts? It studies on the behavior without making judgment, just prescribes how and what should. Whereas normative gives value judgment, identifies the problems and prescribes solutions. Of course, the solutions cannot be proven or disproven by facts alone. So normative economics is also called policy economics because it analyzes the outcomes of the economic behavior and evaluates them as either good or bad. So the methods of economics are based on, number one, scientific method. So this scientific method involves observations, theory, and more observations. So here you devise theories, you collect data, you analyze it, then you verify it either by refuting it or accepting it. So there are assumptions that the world makes when we want to focus on economics. So there are two assumptions that are there. There's what we call the simplifying assumptions and the critical assumptions. Simplifying assumptions are essential features that can stand out more clearly. Then critical assumptions will affect the conclusions of the model. So what are theories and what are models? Now, you must understand that most of what you're learning here is very cardinal for your research purposes, even the quantitative methods that you're going to learn. So you need to understand. So what is a theory and what is a model? So a model is simply a formal statement of a theory. So models are actually descriptions of the relationship between two or more variables. So models are simply simplifications, they're not complications of reality. So economic models are built on words, diagrams, and mathematical statements. You can come up with your own model. So economic models are actually abstract representation of reality. They must be simple to accomplish the purpose. So an economic theory, on the other hand, is a general statement of cause and effect, action and reaction. So theories have variables. So variables simply measure what a certain change of an observation can affect the other. Holding all things constant is a term we use, ceteris paribus, which in economics is meant to mean all else equal. It's an assumption that economists usually make when they're making relationships, to assume other values will remain constant. For instance, if you are talking about a substitute good of Coke being Pepsi, you will not analyze other goods that are there or give implications of what this good can do. So we're just holding all things constant. Now, there are pitfalls that we must avoid in formulating economic theories. So there's what we call the post hoc, the ego propter hoc fallacy, which refers to a common error which usually people make when they are thinking about causality. So in the event that event A happened before event B, it's not necessarily true that A caused B. So just because one event happened before the other, it doesn't really assume that this caused the other. So basically, this is the first part of economics on the decisions that are made. Then we'll now go to the second lecture, which is on the PPF. Unless there are any questions on what has been discussed so far, you can ask now.